Good afternoon, morning, and evening to everyone. Great to be here, and I think one of the challenges that I and my colleagues face in doing this is that all of us have literally a week of material to try to share, and we're just going to pick a few nuggets, each of us, to give you a sense of this universe. For my part, I spend a lot of time now doing these all-day workshops on local investing. And anyone who's interested in that, please let me know afterwards. I've done about 12 of them around the country right now. So this is just like little cherry picking of both an introduction to local investing, and also I think my charge is to talk about some of the more widely available and legally accepted models out there. So the place that I want to start is just to give a sense of what the capital universe of the United States looks like. And I would say that the United States, we have to understand it as a remarkably wealthy country, that our total capital asset base is about $150 trillion. And to put that in perspective, our gross domestic product each year is about $15 trillion. So it's 10 times larger than that. And the slide I have in front of you shows what the household and nonprofit, but mostly household fraction of this is from 2010. So what's not on there is property that's owned by companies, banks, the government, foreigners, but about half of it is this household category. The top slice of tangible assets is mostly housing, but it also includes things like cars and equipment, and it's, as you can see there, it's a little over $20 trillion. The bottom slice, at about $8 trillion, is banks, credit unions, thrifts. Those are all sources of short-term capital. And then on top of that is long-term capital, which, roughly speaking, we'll call securities, and Jenny will define this a little more carefully later. But securities in this category, I include stocks, bonds, mutual funds, pension funds, and insurance funds. And that totals about $30 trillion. And I think what's interesting about this chart is it gives you a sense of, understanding where Americans have their money right now. So I think one point is that banks are about a quarter of the size of the long-term savings and securities. So even if a Move Your Money campaign was 100% successful, it wouldn't really make a huge difference in the larger universe of capital. The other thing that I think is important is that housing is really one of the most important places where people have their wealth. And of course, while we're not going to talk about it, I think any discussion of local investment has to think about how to get more people to own their house or their apartment or their co-op in order to localize some of that wealth. So the next slide that I have is, this is a slide that I often put before audiences when I ask them 3 questions. And I try to make it clear to people that they are responsible for the fact that global companies are tremendously overfunded. And I ask the question, how many of you have done some form of local purchasing in the last week? And almost all the hands go up. And then I ask, how many of you do your banking in a local bank or credit union? Most of the hands go up. And then I ask those of you with pension funds, how many of you have those funds in local small business? And almost all of the hands go down. And to me, this is usually an important moment of revelation for the audience, because at that point I've already explained to people that half of the U.S. actually, if you include the informal economy or you include home-based businesses, the small, the local economy would be significantly larger. But let's just call it half the economy right now to be conservative. Roughly speaking, half of our long-term investment should be going into the half of the economy that is small and local, and right now almost nothing is. And in my mind, what that shows is an enormous overinvestment that we are making in bigger companies and an underinvestment that we are making in local small business. And I think, it's important to think of this as, one of many kinds of mutations from the law that have created an unfair advantage for non-local businesses. The reason for this is that it really comes down to securities law. And I'll just say one thing about it now, and Jenny will say more later. But when securities laws were initially enacted, in and around the Great Depression, we created a system of investor apartheid. And that system is basically, if you're in the top 1% of income and wealth, give or take, you're allowed to invest in anything, anytime, no questions asked. If you're in the other 99%, you actually have a lot of difficulty investing legally until the business in which you're going to invest does a whole mess of disclosures. And these disclosures are complicated, and they can easily cost $10, $25, $50, maybe even $100,000, depending upon the details of all of it. And the result of that high cost of disclosure is that there has been very little money in the securities category that has flowed into local small business. If we were to get the capital markets to operate efficiently, roughly speaking, there would be a transfer of $15 trillion of long-term capital from global business to local business. And, to put that in perspective, that works out to about $50,000 per capita. So it's, you can do the math for your own community about what the level of new capital coming in really looks like. But it's quite significant. So what I'd like to do in my remaining time is just review some of the options. I think I have 7 of them for how we can do some degree of local investing right now. And all of these things are legally well established. So number one is that some people have approached their banks or credit unions and asked them to set up specialized accounts, the proceeds of which are used specifically to support local business. So the slide here is of Equal Exchange, a fair trade company. And in Boston, Equal Exchange, where it's based, approached their local bank, Wainwright, and basically convinced them to set up a special fund that would only support Equal Exchange. And so as a result, Equal Exchange now has a $1 million line of credit. And of course, anyone who's unaccredited can do their banking and put their money into CDs like this. So this is actually an interesting way that people might be able to create a new source of at least lending capital for local small businesses. Co-ops has been a category where there has been a fair amount of local investing. Now, broadly speaking, a co-op membership is not a security, but when a co-op takes a loan from its members, that is a security. But enough templates, enough prior action is out there that many co-ops know how to do this pretty inexpensively. And so I think, this has been one way that people have been able to invest locally. So the Weaver Street Market is an example I have here. Weaver Street is a 13,000-member consumer co-op, grocery co-op in Carbondale, North Carolina. They needed a third store. They needed $1 million. They borrowed it from their members, paying 5 to 8% per year. Number 3, LION. LION stands for the Local Investment Opportunities Network, started in Port Townsend, Washington. The guy on the right started it. His name is James Fraser, former hedge fund manager. And LION addresses a very interesting aspect of securities law, which is that even if you have done a lot of your disclosure work, you still might only be able to approach friends, families, people you have a close pre-existing relationship with. And what Fraser does is he has a monthly party in Port Townsend, brings together businesses and investors, and then passes around a little list to indicate, well, who do you now have a pre-existing relationship with? And this has then given him sort of pointed the direction on how he can circulate business plans in Port Townsend. And just this one little social invention has generated about $1 million of new local investment per year in this 10,000-person community. So, again, if you're thinking about math and like how much local investment could you plausibly see very quickly in your community, take $1 million and then multiply that by the number of times 10,000 people exist in your population. Number 4, municipal bonds. There is a long history of municipal bonds supporting economic development, usually the worst kinds of economic development. So, for example, big corporate attractions or large industrial development parks. Municipal bonds are attractive to many kinds of investors because the income from the bonds is tax-free. I have a picture here of a bunch of food businesses in Boulder County because 2 years ago I did a food study in Boulder County. The principal recommendation there was that we create food bonds in order to bring a new chunk of capital into the county that would then collateralize loans from local banks and credit unions going to priority food businesses. Number 5, grassroots loan funds. Now, the law around investment companies is fairly restrictive. And it is true that if you are, if you want to find a mutual fund to do some investing in, there are 7,500 mutual funds out there, and unaccredited investors happily can put their money into those mutual funds. The problem is that every single one of those mutual funds has chosen not to invest in local small business. It is not because it is illegal. It is because they have made that particular choice. And the cost of creating a new mutual fund that maybe would be a BALLE-esque fund that we would control is fairly hefty. So instead, what has happened is that some groups have looked for exemptions within the Investment Company Act. And so, for example, a nonprofit creating a revolving loan fund for small businesses is not considered an investment company. And so this guy, Steve Fireman, who comes to some BALLE conferences, has a nonprofit in Columbus, Ohio, called the Economic and Community Development Institute, and he has 14 funds. He is the local business banker of Columbus, but the 14th fund he got permission from Ohio securities regulators to allow unaccredited investors to participate. Number 6, investment clubs. Groups of people, usually small groups of people, can come together and they can put money into their own pool, and as long as they are all involved in the decision-making of where the money goes, an investment club is another way you could do local investment. So the picture here is from No Small Potatoes in Maine, an offshoot of Slow Money, and they invest in local farms and local food businesses. The last thing I want to mention is self-directed IRAs. This has long been established in the law, but remarkably few people are aware of this, that it is legally possible to roll over money from an IRA that you have that is, only invested or could be invested in very global securities, and then to put that in the hands of a custodian that you hire. And if you shop around, you can find a custodian for $200 or $300 a year. And with that self-directed IRA, you can invest in everything we just talked about. In fact, you can really invest in almost anything you can think of except your own home or your own business. But you could, for example, invest in your neighbor's home, and your neighbor could invest in your home. So there's things you can do with that there. The last thing that I wanted to point out was just on rates of return, because there is a lot of discussion that one hears even in places like Slow Money, where people say, well, with local investment, we're not going to get a market rate of return. And that whole discussion is predicated on a belief that a market rate of return is 5, 8, 10, 12%. And in point of fact, and I do this, make these calculations in the front of local dollars, local cents, the historic rate of return of Wall Street in any 12-month period since 1879, if you add dividends and remove inflation, is 2.6%. So that is the point that one must beat. My argument is that there's a lot of local businesses that can beat that 2.6%, and it's our job to try to identify more of these opportunities and turn them into investable portfolios. And one thing that I think about is when the first $1 trillion moves from Wall Street to Main Street, what's going to happen is that with less demand, the prices of those Wall Street securities are going to decline, and the prices of Main Street securities are going to go up, and that's going to grab the attention of investment advisors, and the next trillion will move more quickly. So I think this market imperfection that stands in the way of local living economies may well clear out of the way very quickly once we get things going. Let me stop there, then we'll move to the next speaker.
Okay, so I'm going to start off with a brief introduction. My name is Elizabeth Yu. I have worked for 10 years in different nonprofits that help connect social entrepreneurs with social finance, and my particular obsession has been in the food world. So I worked for Slow Money for 2 years. I worked for BALLE for a bit. I worked at RSF Social Finance. And I'm definitely obsessed with the question of how do we get the most appropriate types of capital and financing to particularly food entrepreneurs, but also any social entrepreneur that makes up the building blocks of a local living economy. And so although the book that I've just written, Raising Dough, The Complete Guide to Financing a Socially Responsible Food Business, is written specifically with food entrepreneurs in mind, it's definitely got resources that are relevant to any type of entrepreneur, and particularly those that are smaller, community-based, independent. So that's my bias, that's my obsession. I love following Michael because his presentations are very focused on the investor perspective, and my undying devotion is to the entrepreneurs, so we make a good pair that way. And the apology that I want to make is that I was asked to give a few examples of community capital tools that people can use, but instead I'm going to start with a landscape overview of some of the distinctions and what we mean when we're talking about community capital and different financing tools. And the example I want to use for why this is important is that it's very, very common that someone will give a half-an-hour presentation on crowdfunding and never explain which type of crowdfunding they mean. For instance, we could have been having a conversation about using an online platform to promote a gift-raising campaign where there's no financial return, and a lot of the campaigns on Kickstarter or Indiegogo are examples of that, and I'll talk more about that later in the presentation. We could be talking about pre-selling a product, or where you sell a product in advance that will be delivered later. Or we could be talking about selling securities, which I'll talk about a little bit. Jenny will talk about in much more depth, whether it's debt or equity to a large number of non-wealthy investors that do expect a financial return. So these are three very, very different things, but they all at the moment get lumped into the umbrella term crowdfunding. And so the reason I'm giving this presentation instead of the one that Marion had asked me to give, although I will give you a few tools at the end, is because I want to equip you all, and this is part of my Train the Trainers curriculum in general. I'm going to be doing a lot more training the trainer type workshops this year and beyond, is I want to make sure that you as leaders in your community and as conveners of conversations of community capital know when to interrupt the conversation and say, wait, hold on, what exactly are we talking about? Where in the map of community capital are we actually right now? And so this will help you with some distinctions so that you know when to interrupt that conversation. So the distinctions, and this is the fog coming in on Ocean Beach where I am in San Francisco on the edge of Pacific Plate, and you'll see why the fog is the gray area takes over. Okay, so one distinction, we have individual and institutional options. So individual investors, I put investors in quotes to remind me to say that this doesn't necessarily mean people investing money that they want to see a financial return on. It could be investing through gift money. It could also be investing through where they're making their purchases. But these are individual people. And then there are institutions, whether those are nonprofits, banks, microfinance organizations, community development loan funds. Those are what I mean by institutional options. And then the gray area, the fog comes in. We also have intermediary institutions that allow individual investors to make investments into our local businesses, even if the individual investors can't do so directly. And so an example of an institutional investor, like some community development loan funds, they do allow local people to invest, non-accredited investors. Some of them don't. So in the gray area, some distinctions here to make sure we know what we're talking about, what types of investment options are available. Michael already mentioned this, the two major forms of financing. I actually should have included gift money here also, but I forgot. Debt and equity. Debt is loans, credit. You give somebody the money up front. They pay it back, usually with interest over time. Equity means you actually sell a portion of your company. And if you want to pay the investors back at some point, there needs to be some sort of event, some kind of windfall of cash so that you can pay your investors back, or you can pay yourself back if you want to stay, send the kids to college, get out some of your investment. And then the gray area, the fog in between, there are some ways of investing that are not really debt and not really equity, some forms of revenue sharing models, which Jenny, I'm not sure if you're going to talk about that later, but you know, there are some ways to get money into businesses. They're not really debt and not really equity. So another distinction is it a security or is it not a security? And Jenny will talk a lot more about this. And again, the gray area in between is that yes, the Securities and Exchange Commission would probably deem some forms of financing securities, but nobody usually treats them as such. And will they ever find out about it? We don't really know. So that's a gray area, which leads into the next distinction, which is, are these things legal or are they not legal? And the gray area in between is, well, first of all, the laws are changing, and Jenny can speak more to that. I'm not an attorney. But there are quite a few things that happen all the time that are not technically legal And I see Angie is saying that she lives in the gray area. Yes, I think many of us do. And many of the community financing models that people talk about are in the gray area. And so again, I was asked to present things that are legal, but for me, my bias is that, again, as community leaders, it's important for you all to know all of the tools that are available to help people understand some of the distinctions between them, and so to start thinking about ways that we can help make some of the things that are in the gray area more legal. Nikki had asked about the informal economy and the formal economy, and I think that's a huge question, an area for growth and an area for both formalization and at least acknowledging that these things exist and helping people access them to the extent that they're willing to take on some risk, so long as we make sure it's clear what the risks are that they're facing. And then again, to me, I have a bias. Like, what do we mean when we're talking about community capital? So this is not to scale. This is more of a conceptual thing, but I don't even know what you call this color in the middle. But things your community members can invest in, the part of the pie chart that's broken out, there are things that individuals can invest in directly, and then there's things that they can invest in via intermediaries. To me, community capital also consists of the local institutional debt and equity options that your community members can't necessarily invest in themselves, but these are there are flows of capital that exist within the community. And then the biggest part of this pie, again, I have no idea how to actually quantify any of this, but there are so many different capital and financing options in the universe that might flow into your community and support your community's entrepreneurs, whether this is gift money, debt, or equity, or some of those things in between. And as community leaders, I think it's important that we know what those are and how they can come to the table, what some of the pros and cons are, what some of the pitfalls are. And I'm really looking forward to diving more into this on the 9th when we're all together in Oakland. But my bias is that, and what the book tries to do is uncover all of the options and start to explain how they might fit and be appropriate with the different values of the entrepreneurs that we're supporting. So there's several other considerations when we're talking about different financing and capital tools. So these are just several spectra. How expensive are they to pull off for the entrepreneur or for the investor? How quick, or does it take a lot of time? How much paperwork is involved? Can you do it on your own, or do you need to hire an attorney or an accountant or some other professional, broker-dealer, maybe an investment banker? How easy are these things to manage? A lot of things that fall into the, quote, community capital bucket are actually very complicated and not necessarily good for introverts. You have to actually do a lot of community engagement, and not everyone that you will serve through your BALLE network or through whatever organization you're associated with is up for all of that. So this is something to keep in mind. And then this whole question of credit scores. Like, this is a really big deal in a lot of particularly communities that have not traditionally had access to a lot of financing tools, is that a lot of people have lower credit. So what does that mean? They're automatically going to be barred from several existing institutional options. So how else can we help folks that we know might not have the best credit scores? So again, I talked about the importance of then, once you know what all your financing options are, making sure that we align those with the values of the entrepreneurs who are seeking those financing. And then on the other side, which I don't talk about in the slide, is we also need to make sure we're aligning those with the values of the investors that we're trying to connect with the entrepreneurs. But some of the things on the investor side is how quickly are they expecting to grow? Or do they intend to keep ownership locally or to themselves? What's the ideal business size that they're hoping to achieve? What kind of lifestyle do they want to live? Are they going to try to shoot the moon and work hard and not talk to their families, or do they want to have a more balanced lifestyle? What is the rate of growth they're hoping to achieve, work on? How long have they been in business, and how long has this entrepreneur been collecting revenues? And what is their commitment to local? Is the goal to always be a community-oriented business, or do they want to become the next organic whatnot in a huge box store? I mean, frankly, I think that all of these businesses do currently exist and add to communities in different ways, but we can't really make assumptions about what it is that the businesses that we're serving are trying to do. And so asking some of these questions and making some of these distinctions is really helpful when we're trying to connect them with the appropriate capital. So with that, I'm going to jump into some specific examples. And I'm going to add one to what I have here because it's come up a lot in the questions, or I think it's an answer to a lot of these questions. But friends and family loans, I have here a picture of my Thanksgiving dinner at my parents' house last year. And the important thing I want to say about friends and family loans with regard to the distinctions I gave earlier is that I think in many cases, and Jenny can speak to this, these do actually fall into the category of securities. But hardly anyone ever treats them as a security. And in fact, there's a whole Nolo Press book on making friends and family loans. And they don't even mention the whole concept of securities law at all, which I think was a huge oversight. But the important thing to mention here is that when you are connecting community members or family members with each other to make loans for businesses, you want to make sure that your Thanksgiving dinners are still friendly and that your friends are still your friends, that you don't end up having bad blood within the community if something goes wrong. And so the easiest way to do that is to make your loans very, very formal. So the next slide has some examples of different online systems that help you formalize a loan. And I'm not actually advocating any of these in particular. And in fact, a lot of them charge money to do things that you can often find for free. So again, the important thing to know is just if you are aware of or encouraging people to do friends and family loans, be aware it's in the gray area of securities law, and which again, I don't really know where that is. I'd love to hear more from Jenny on that. But make sure that people formalize those loans. That's the number one piece of advice that you can offer in that regard. And this is where a whole lot of money comes from to start new businesses. The next option I wanted to talk about is peer-to-peer lending. And unlike the name, peer-to-peer lending usually does not involve lending or borrowing money from people you know at all. What this basically means from the entrepreneur's perspective is you go online, you set up a loan for a purpose that you're trying to raise money for. It can be a business. It's often a personal loan either to refinance existing debt or people even put up loans. They want to go on a big fancy wedding, or they're trying to buy a wedding ring. I mean, there's any number of reasons you could go on Prosper Lending Club. And this is a not well-known and better alternative, I think, to credit cards. And again, a lot of small businesses are started by the owners putting expenses on their personal credit cards. And the rates that you can get through Prosper Lending Club online are much, much better often than what you can get from a credit card company, particularly if you have not the greatest credit scores. So unfortunately, if you have very low credit scores, you're not going to be able to get on either of these platforms either. But I think, again, as community leaders talking to people about different ways of accessing financing, this is a great one for people to know about as an alternative to traditional credit cards. And you can actually use it as a way to formalize loans from people that you know. It's just that these platforms are actually becoming very popular with institutional investors. So although you can as an investor go on and find local loans, you have to almost compete now with institutional investors to be the ones that are funding the loans. So these are two online peer-to-peer lending platforms that connect borrowers with people seeking loans. The next tool are...
Just a time check. You have about 7 more minutes including questions. So just FYI.
Including questions. Okay. So community-supported models I'm not going to talk a lot about, but again, in terms of distinctions, there are some of the earliest CSA models were really equity-based, and people came together and supported the full cost of the farm and literally had to share proportionate to their level of ownership. That doesn't happen a lot anymore. Most community-supported models now involve people either subscribing to it's a subscription service or it's a model of pre-sales. But this is a great way that, again, falls in the gray area of securities law. If the business doesn't already exist and is using pre-sales as a way to finance the business before it launches or before it has ever offered the product in question, that can be a security. But this is a very common way that businesses are raising money from their community members. And I'm a huge fan of these community-supported models, whether they're subscriptions or pre-sales or even the more formal early equity-based CSA models, because rather than just going to a bank, you're actually engaging with your community. You are building your customer base, you are building a whole collection of ambassadors for your business that will then support it over time. So these are exciting to me. We can talk about those in more detail next month. And crowdfunding online, either as a way to formalize a gift-raising campaign. So here's one example. The Roxy Theater in San Francisco was recently purchased by a nonprofit, and they raised over $62,000 by offering, very nominal rewards in exchange for people making donations through Kickstarter, one of the online crowdfunding campaigns where you put up a video of your project and describe what you're doing, and if you have a goal, and if you don't meet the goal in Kickstarter's model, you don't collect any of your money, and then you blast it out to all of your people through social media, Facebook, Twitter, etc. Indiegogo has two models. One is a all or nothing, where you have to meet your goal or you don't collect the money, or they also have a threshold model where you have to meet your goal. And there are pros and cons to the different crowdfunding platforms. These are just two. There are several more. Another example of using Kickstarter or Indiegogo is as a pre-sales model, and this is an indoor hydroponic vegetable growing system. They raised $250,000. And this project actually highlights some of the challenges and some of the potentials here. So they said, we're going to raise $50,000 through pre-selling these things, but if we raise $200,000, we'll actually produce them using recycled materials in the United States. So this Window Farms example, and I can send the link around, is actually pretty fantastic in terms of their understanding of some of the issues of producing locally, but also what happened is it was so successful that they ended up having, it was a bit of an issue. They underestimated how much these things would cost, and it was so successful that in the end they kind of lost some money having to ship out so many of these products at a price point that turned out to be less than the cost. So pros and cons to these models. And then I just wanted to add, and I said this also in the chat, but I don't know how many of you are following the chat, but I'm not sure who had asked about Tondas, and then Nikki had asked about formalizing or at least the informal economy and what can we do about that. And I had actually recommended to BALLE, and there's a webinar, and I'm not sure how you all have access to the webinars, but I'm sure that's possible somehow. But Mission Asset Funds is a nonprofit in San Francisco that is formalizing lending circles or Tondas. They're called all sorts of different things. They exist all around the world, and it's basically a group of people comes together, they pool money together once a month or over some period, and then every time they come together, someone takes home the pool of money, and it circles around. It's a rotating credit model. And what Mission Asset Fund is doing is they're starting to formalize this. So they'll work with usually a local nonprofit that pulls together the community, but they do all the back end, and they treat it as a loan, a formal loan. And so when somebody comes every month and pays in their share of the pool that month, they consider that a successful loan repayment, and they start reporting that as a positive credit history so that people that have traditionally been part of the informal economy can start building a credit record, which is of crucial importance later when it comes to accessing more institutional forms of capital. So I'll stop there.
Hi, everyone. So as has been mentioned, I am a lawyer, so I do look at all of this from the legal perspective, but I'm not the typical lawyer that just says, no, you can't do that. I do try as hard as I can to find all the different ways that we can do this and do it legally. And it is true, as Elizabeth says, that there are certain areas that are a bit gray, unfortunately, but I will explain some of that as I go along. So many of you have probably seen this slide before, but this is Janelle Orsi, who is a colleague of mine who co-founded Sustainable Economies Law Center, loves to use cartoons to explain legal issues. So I use her stuff quite a bit. But yeah, I think the point of this is that we all need to understand as best as possible the basic securities law issues that come up when we're dealing with raising money for our own ventures or trying to connect investors with businesses. So what exactly is a security? And one thing, so under federal law, it's any time you have some kind of scheme where somebody invests money in a common enterprise, which is basically any kind of business or venture, and is led to expect profits from that enterprise, and not from their own efforts but from somebody else's efforts. So they don't really have control over how the money gets made. So it's really any time anyone puts money into something expecting a financial return. But it's also important to understand that there's both state and federal law governing securities. So you may be 100% in compliance with federal law, but if you're not in compliance with the laws of the states where you're offering your securities, you could still get into trouble with the states. So under state law, a lot of states have the exact same definition or almost exactly the same definition as the federal definition, but there are about 15 states that have a broader definition, and this is called the risk capital test. And this is why some of the things that are happening on these crowdfunding sites are in a gray area. So the risk capital test asks, are the funds being raised for some kind of a venture, or is it being offered to the public? Are the investors powerless to affect the success of the venture, and is their money being put at risk? And that's kind of the tricky one, because what does it really mean at risk? So, you know, you could say if I go buy a Starbucks gift card and Starbucks goes out of business tomorrow, does that mean that Starbucks just sold me a security because I bought something and my money was put at risk? Well, probably not. You know, the states probably wouldn't call that a security. But what if I buy a gift card from a business that doesn't exist yet in the hopes that it will exist and then I can use my gift card? Then there is a decent chance that that could be considered a security under state law. So, you know, a lot of things that are happening on these crowdfunding websites I think are in that gray area, and I wouldn't be surprised if we do start to see some crackdowns from state securities regulators on some of these, but we'll see. So if something is a security, as Michael said, the general rule is that you have to do a registration process both at the federal level and in every state where you want to offer your securities. And to do this full federal registration process and state level registration can be at least $100,000 in cost. It's not often much more than that. And that's what people do when they do a full IPO. You know, when a company goes public and they do this big process with the SEC and they file all these disclosure documents and detailed financials audited by a CPA, you know, that's the federal registration process. And then there are exemptions to that general requirement that you have to register securities. But as Michael said, most of those exemptions are really only open to accredited investors. So if you offer a security only to accredited investors, it's much, much easier to qualify for one of the exemptions from the registration requirement. Another thing is that there's a distinction between offering to the public and offering privately. So as long as you don't advertise your offering to the public and you only do it with, you know, you only talk to people you know, or, you know, talk to a broker who has clients that they can show the offering to, that's considered a private offering, and that's also easier to fall within an exemption from the general requirement of having to do this big registration process. So are there any questions so far on that? That was my quick overview of securities law. Okay, I will assume that's a no. So there are some ways to offer securities to the crowd in spite of that are legal now, and then there's going to be a new thing that's going to be hopefully legal soon. So I'll talk about the three main ways that people are doing this. So Lion, Michael mentioned Lion, and that's where, from a securities law perspective, what Lion is you within your state you don't have to worry about the federal securities law because there's something called the intrastate exemption. And that doesn't mean that no federal securities laws apply, but you don't have to worry about the registration requirement. So as long as you're doing everything within your state and all the businesses you're working with are very locally focused businesses and incorporated within that state, there's no concern about the federal registration requirements. But then what you have to do is figure out in your state what are the requirements for doing a private offering. And every state is a bit different, but if you can figure out, some states it'll just say, as long as you don't advertise the offering and as long as you don't take more than 15 unaccredited investors, you're fine. Other states it'll say, as long as you don't advertise the offering and don't take more than 25 unaccredited investors and file this form, you're fine. So you really have to know exactly what the requirement is in your state. And once you know that, you can set up a private club where you can connect investors with potential investments and make sure, help make sure that that the businesses that are taking the investments are complying with those rules. And of course, you need to be careful. If you're the intermediary, you need to be careful also not to be, providing legal advice or serving as a broker. But as long as you're just sort of giving people information about how to comply, you should be fine. So then the next thing I want to talk about is the new law that's coming down the pike. It has not gone into effect yet, and we don't know exactly what it's going to look like. But I just wanted to not everyone knows. There's kind of a lot of mythology out there about how this new law came to be. And the person who I would say started this whole thing is on the phone right now, Michael Shuman. He wrote an article saying he wrote an article in this publication of the Federal Reserve Bank saying, these laws make it so incredibly hard for people to invest in their own communities. Why not create an exemption from these very onerous laws that says as long as you're not investing more than $100, you don't have to go through this whole big process. And so it was kind of this crazy idea, but the point was just to say, isn't it silly that you can't even invest $100 in your own community without making the company you're investing in break the law? So a lot happened after he wrote that article. My nonprofit, Sustainable Economies Law Center, wrote a letter to the SEC requesting an exemption that, that exemption, the $100 exemption. A lot of the word spread about it. It kind of got into the hands of a lot of people that really wanted to see something like this happen. And eventually the CROWDFUND Act was adopted. This is the letter we wrote to the SEC. And a lot happened between that and this happening. But amazingly enough, last April, and Michael and I were there, the CROWDFUND Act was signed. It changed a lot from our original proposal. Unfortunately, I would say a bit for the worse. The good news is that under the new law, people will be able to invest up to 5% of their annual income or net worth. And these offerings will be exempt from state registration requirements. So you'll be able to offer in all 50 states pretty easily. You'll be able to raise up to $1 million. The bad things about it, in my opinion, are that you have to use an intermediary. You can't go out directly to your potential investors. You'll have to have reviewed financials if you're raising more than $100,000, and probably audited financials if you're raising more than $500,000, and that's very expensive to get. So that's going to lock a lot of people out of it. But the truth is, we really don't know much about what it's going to look like because the law was full of kind of vague parts that the SEC has to do detailed rulemaking about, and we haven't seen the proposed rules yet, and they've missed their deadline to complete the rulemaking process. So we'll see what happens with that. But and so this just shows it's kind of frustrating. You can't, if you use this new law to raise money, the only thing you'll be allowed to say to your potential investors is, please go see this website, of the intermediary. You will not be allowed to talk about your offering yourself, which I think is really silly. So we are working with American Sustainable Business Council to do some advocacy to see if we can make the law a little bit friendlier to small local business. So then the last thing I'm going to talk about is direct public offerings. This is legal now. I was just in this crowdfunding conference yesterday in Silicon Valley, and this guy said, yeah, with this new law, we're going to be, you'll be able to offer the investments to the public. Before this law was passed, it was illegal to do that. And I was like, that's totally not true because this has actually been going on for decades. A direct public offering is an offering of securities to the crowd. It's completely legal. under existing law. We don't have to wait for this new law to go into effect. The big difference between what's currently legal and what will be legal under the new law is that you do have to deal with state-by-state registration. So the way that it's legal is you find a federal exemption from that registration requirement, which, as I mentioned before, is very expensive, and then you do state-level registration. So the big difference between what will be legal under the new law and what you can do now is that if you tried to do an all 50 state offering under current law, it would be very onerous and time-consuming and expensive. Whereas under the new law, it'll be much easier to do all 50 states because states are not allowed to require you to do a state-level registration under the new law. But because we're BALLE, probably we're a lot more interested in things that will be focused on 1 or 2 states anyway. So a lot of what we want to do is completely legal under current law and is happening now. So I'm just going to show you a few examples of my clients that are doing this now. Farm Fresh to You, and as Elizabeth mentioned, you can get really creative with the types of securities you offer. Some people say, oh, it's either equity or debt, and this is something someone said yesterday. Well, if it's equity, you're going for the growth play or whatever. And it's like, no, you can be a lot more creative than that. Equal exchange, if you invest in equal exchange, you will never make money off of the growth of the company. You will never, become a multimillionaire by investing in equal exchange, but you will make a nice steady return on dividends every single year. And if you had invested in them 20 years ago instead of the stock market, you would have done much better. So there's all different ways you can structure it. You don't have to say, oh, I'm just going to sell you some stock, and then when I, am bought out by Coca-Cola, you're going to get rich. So I just like to show all my different clients and all the really creative tools that they've created to raise money in a way that fits with their goals. So Farm Fresh to You is selling a debt instrument, so it's a loan, and it's actually paid in credits towards their product, so they don't have to actually pay it back in cash unless someone moves out of the state. Real Pickles is a worker co-op that just completed the legal work to offer their security, and they're raising money selling a non-voting preferred stock because they're a co-op. They don't want their investors having any voting rights. Quimper Mercantile is a business in Washington. They're selling common stock, and the minimum investment in that company is $100, and they already have over 1,000 investors. And I do want to say that there's if you have over $10 million in assets and you go over 500 unaccredited investors or over 2,000 total investors, it can have a consequence that can be unpleasant, which you fall into like a new category of regulation. So that's something to watch out for. But Quimper knew they would never have over $10 million in assets, so they were fine with going over 500 unaccredited investors, and they're continuing to raise money. They've raised hundreds of thousands of dollars, and they were a startup. They hadn't opened when they first started, and now they are open for business. It's a retail store. People's Community Market, as Nikki mentioned, is right now raising money selling non-voting preferred stock to be able to open this new beautiful market. We ourselves, Cutting Edge Capital, is doing one. We felt like we had to do one ourselves to put ourselves in the shoes of our clients. So what we're offering is a revenue sharing agreement, which is one of those things that's neither equity nor debt. It's just the right to receive a percentage of our gross revenues every year for 5 years. So that's another creative tool you can offer if you don't want debt, but you also don't want to sell a piece of your company. And by the way, if there are California residents on the line, this investment offering is open until the end of June. We would love to have you invest in our company. So direct public offerings are great because you can go out to the entire world. You don't have to just limit yourself to accredited investors, which means you have a 25 times larger pool of capital that you're going after. You can keep control of your company because you we'll have a larger number of small investors, and no single one is likely to demand control. And if they do, you can just find someone else. You can advertise to the public, like I just did for mine. You set the terms of the deal. So you decide what you want to offer, and then you offer it. There's no negotiation process. The securities are unrestricted, so potentially, and that's not always the case. There could be some state-level restrictions on resale, but generally speaking, they can be resold. So I'm working with John Katovich, my business partner, right now on creating a secondary trading market for these securities, so that'll be really exciting. So you'll be able to not only invest in the initial offering of a company, but you'll be able to buy these securities from others who did invest and then maybe need to exit for some, they want to exit because they need braces for their kids or whatever. Let's see. And then a lot of people get confused. They think if they do a direct public offering that they then become a public company and have to do quarterly filings, and that's not true. You can become a public company, but you don't have to. So there's really generally speaking, there's no ongoing reporting requirements. There may be some depending on your state, but usually very minimal.
Hey, Jenny, could you just mention for 1 second, aren't you guys working on software that will help make it easier to get a DPO?
Yes, part of the reason we wanted to raise money ourselves was to be able to pay a software developer to somewhat automate the process of doing DPOs, and that's really just going to be for our internal use, at least for now, to make us more efficient on doing DPOs. But eventually we may get to the point where we can have like a legal Zoom for DPOs.
Great, thanks.
The only hard thing about that, of course, is every state is a little bit different for doing a DPO, so it can take some time if we really want to be able to offer that broadly. But Mission Markets is our partner on setting up the secondary trading market. They're also they do a lot of cool things that I just want to mention. They're trying to become a one-stop shop for socially responsible investing. Right now, all they offer is private offerings open only to accredited investors, but eventually, hopefully, they will be able to offer direct public offerings under the new CROWDFUND law. I think they're soon going to have a donation-based crowdfunding platform. So it will be a place where you can go and just find all these socially responsible investing opportunities, nonprofits, for-profits, co-ops. They also offer community portals, so they are working with a few different organizations to set up like branded portals so that you could have, for example, a portal just for your city, where people, and it's the back end is all run by Mission Markets, but the front end is branded for your community and like customized for your community. And Michael works with them too, so he can also talk about that. In fact, Michael manages the community portal process, I think. And let's see, and then like I said, there's going to be hopefully secondary trading on that platform pretty soon. And there is a licensed broker backing them up, so it's legal for them to actually, connect investors with investment opportunities. And that's it.